It is time again for a new tutorial. This time is going to be a tutorial about the new Variance Center. So the Variance Center is now exclusive to Gamma Optimizer members, so you're part of a very exclusive club. And I know there are lots of new members that have no idea about what the Variance Center does. No? So the Variance Center does a bunch of stuff. There's like lots of information spread all over the place. So let's focus first on the, I guess, the most immediate one, which is the NDLA. So you can see here the NDLA table. The NDLA table is just a prediction for a move in SPX for 1 week. For instance, I am recording this on April the 2nd. And the prediction is 0.27. The probability of the prediction is 0.27, which means a negative signal. A negative signal is anything with probability lower than 0.5. No, it's something that you have to take into account. So we have a negative signal for next week. And so, and the target for the negative signal is 2,895. In other words, the algorithm thinks that their value won't be seen. So SPX can stay just below it, fall, or go nowhere, but it seems that the algorithm is thinking that nothing will happen in the market for these levels. And in fact, if you notice, the table also has historical information for the past 10 sessions. So you can see that we have about 3 negative signals in a row. We started having negative signals since in March 29. So we'll see if the market complies or not. In the room, we are not playing the negative signals. We only play the positive ones. We did a limited experiment with the negative ones, and it worked really well. It's just that the risk reward is not, it's not something that I feel comfortable recommending to my members. It's something with such a low risk reward. But if the regime changes, I might start doing this again. So that's what the NDLA table is. And also, as you can see, we had previously 3 positive, 4 positive, 5, 1, 2, 3, 4, 5. 2, 3, 4, 5, yes, 5 positive signals in a row in this area. No? If you look here, you'll notice that we have positive signals, and we play all of them, every single one of them. No? And so far we have collected in 4 of the 5, and we have collected really decent returns. So we are seeing more than 150% return weekly just playing the signals. And notice that all of the signals came one day after another, so we played them one after another. It's like it's like a burst of positive signals. So that's how we play the NDLA. The NDLA has very few signals here and there, but when they appear, they tend to appear clustered together, and we need to play them right away. So that's the NDLA table. And I'm going to jump over the statistics of the NDLA. So the statistics are also visible for non-members. In fact, it's the only thing that is visible to non-members right now. The statistics are broken in periods of 20 sessions, 20 trading sessions. So a trading session is just a trading day, 5 days per week. So 20 trading sessions is about 1 calendar month. So we have here 1 calendar month of return. As you can see that in the last month, the signals column is the number of signals we have seen. We have seen 5 signals from the algorithm, and all of the 5 signals have been fulfilled. No, which is what we have here. So we have 100% accuracy, but so don't let that mislead you. That's the accuracy of the last month. If you notice, for the last 2 months, the accuracy drops to 90. So out of the 10 signals, 9 were successful. And it starts coming down. And long-term performance is around 55, 56%, which is very good. Remember that the way the NDLA works, the NDLA is not an even money bet. It's better than even money, so it has a nice positive edge even at 55% precision. The other column, so that's the precision of the algorithm. The other column is called the partial precision. The partial precision is when we measure when the market moves towards the target, but it kind of comes back later. And I mean, maybe we get the move before the 1 week that the algorithm always predicts. So partial precision is incredibly high, it's 100%, and long-term partial precision is 84%. So the algorithm does have a very, very good predictive power for moves up, even if they don't stay at that level by the end of the 7-day period, but it does have a fantastic prediction rate. What the algorithm doesn't have is good recall. For those of you that are familiar with statistical measures, in particular for binary classifiers, the recall is the amount of 1% moves that we are missing. And the algorithm is missing a lot. The algorithm, it tends to capture kind of half of them, sometimes 68%. Sometimes we have better recall than others, but in general, the algorithm, the recall can always be improved. And I am working in a different neural net that the main objective is to improve recall. Because if we improve recall, we also improve the number of signals that we get per month. And that's what we want. We want to have a lot of signals, but we also want to have good quality signals. So at this moment, I am making an interesting compromise. I am sacrificing recall for good precision. So that's what I am doing at this particular time. The negative column shows the precision of negative signals. It looks really high. It looks that the algorithm is also really good with negative signals, but you have to remember that there is a null hypothesis. And so these two columns are really connected. The naive column shows the null hypothesis of the algorithm. That means the market moves 1% on its own. No, it moves. And the naive column shows the results of a strategy that plays that. So a naive strategy is a strategy when you assume that the market will always move 1% every week, always, all the time. And notice that the naive algorithm has a very good performance too. It has, for instance, it has been 45% in the last month, but historically it tends to hover around 30%. It is the historical performance. So you will expect historical performance of negative signals to be around 70%. No, if the naive strategy is 30, the opposite of the naive will be 70. So the NDLA is good for negative signals, but not that good. No, for instance, notice that like positive signals do improve significantly over the null hypothesis. So we have 45% precision for the naive, yet the NDLA has 100%. So it's a tremendous improvement. And also in the long run, the improvement is really good. We have 35 versus 55. However, in the negative, you can assume the improvement is okay, but it's not that good. For instance, you will have 55% negative signals and we have 73. Well, it's not that bad. It's actually not that bad. But I am not playing negative signals with the algorithm. We could do it, but I'm not doing it because of the risk reward. So this is so far what we are seeing related to the NDLA. The Variance Center also offers the GT level, which I think is a little gem. This is the hidden gem in the tool. The GT level is that level where option dealers are neutral in terms of gamma. So the computation is very simple. You know that in SPX options, dealers are buying and selling options, calls and puts. No, they are making markets for you. And the assumption of this algorithm, this heuristic, is that option dealers tend to be on the aggregate short puts because most people buy puts in SPX, and that's puts are bought in XPX because they are used as insurance. No, big funds, big mutual funds, even hedge funds, people that has a charter to protect the investment has to buy the puts. So if they are buying the puts, then the dealers are short the puts. On the other hand, the calls in XPX tend to be long the calls because people tend to sell them. I don't understand why. And I have seen it in the main room all the time. I mean, when you have a diversified portfolio, people tend to sell calls against the portfolio, sell cover calls against the portfolio just to juice returns a little bit. So there is a lot of call selling as part of bigger strategies. So in the aggregate, option dealers are mostly long the calls. No? Of course, this is a very simplified assumption, but you have to start some point. So that's the assumption I start. So with that assumption, I take all of the options in SPX, I guess it's like 12,000 of them at this time. I always forget how many of them are. There are a lot of them right now. And for all expirations, and I model them with my own proprietary model, which is a variation of Black-Scholes-Merton, but it's one that accounts for stochastic volatility. And then I compute the point where the delta of the puts cancels the delta of the calls. No? And that point is interesting. That point is the GT level. In this case, the GT level is 2,794. Why is the GT level interesting? The GT level is very interesting because as an option dealer, I have to hedge my exposure. No? So if my total exposure is in calls, remember I am long the call, so I am long gamma. No? So above the GT level, option dealers are long gamma, and that's what we have right now. We are in a long gamma regime right now because the market is trading above the GT level. This is significant because in a long gamma regime, option dealers trade against the market. So if you, in your head, if you start thinking about how options are hedged, you'll notice that in a long gamma regime, options are hedged against. So if the market goes up, I need to sell. I need to sell the basket in order to remain neutral in my position. So what happens is if there is a lot of upside pressure in the market, option dealers come into the market to sell, so the upside pressure gets lower, and so the hedging activity from option dealers kind of breaks. It's like a break to market action. And vice versa, if the market falls dramatically, option dealers have to buy the basket in order to neutralize the deltas. So if the market is falling, they come to the market to buy, and they offer support to the market. So in a long gamma regime, option dealers are kind of breaking the market, making it trade in a little band. And we have been trading in this band for quite some time. We have been long gamma for a very long time. But before we used to be short gamma. So long gamma is an interesting regime. The net result of being in a long gamma regime is that the market tends to have lower volatility. No? So the market doesn't have that much volatility because any volatility is being absorbed by option dealers. They are kind of acting against volatility. Another consequence of low volatility and being long gamma is that the market tends to just drift upwards. So when volatility is low, there is calm in the market, big players are not relocating positions, people are not making change into portfolios, so the market tends to kind of like just drift up, and this is what is happening also for the last month. So that's why long gamma is significant. As you might imagine, if we drop below this value, then we flip short gamma, and short gamma is the complete opposite. If that's what you had been imagining, that's correct. It's the complete opposite. Short gamma means that now option dealers have to hedge with the market. So in a short gamma regime, if the market falls, option dealers need to sell to remain neutral. So the market is falling, option dealers are selling, the market falls more, option dealers sell more, and it's like a feedback loop. No? And also in a short gamma regime, also if the market goes up, it's the same thing. The market is down, is here, the market goes up. So option dealers need to buy to remain neutral. So they buy, the market goes up more, they buy more. So all of these up and down moves tend to be exaggerated tremendously by hedging activity. So short gamma regimes are very interesting. We just came out of one. Now we were in a short gamma regime towards the last part of 2018 and the first part of 2019. So that's why the GT level is so important, and that's why it's so important to understand where we are. And as part of that, the gamma imbalance shows you more or less the imbalance between calls and puts per strike. So you can see where most of the action will be. So here you notice that most of the action is right now in the 2,850 strike. So that means that those strikes will act as what I call hedging walls. So there is plenty of hedging walls at 2,800, 2,850, 2,900. So market activity tends to be limited within those ranges. So the market can go up and down, but it tends to be within the limits of the hedging wall. So it's interesting because it changes real time too. And finally, but not least, is the variance chart, or no less, no, I don't know what the expression is the variance chart. The variance chart shows intraday realized variance, which is only a fancy name for intraday realized volatility. I call it realized variance because it is a slightly different computation from what you will get from your broker. I am assuming that the mean of the sample is zero all the time. The zero mean assumption is something prevalent in the financial literature, and I mean all of the banks use this, and it works because in reality most of the time the mean of all of these micro moves is always zero. But in very strong trending markets, the mean will not be 0, so it will be a difference. But I'm digressing. The important thing is that this measures the intraday realized variance. That's the most important thing. It's a measure of volatility minute to minute. Right now it's incredibly low, it's 5.82. When it's very low, it means that the market is not changing that much from minute to minute. And that's a signal for high liquidity. There is appropriate liquidity in the market. Also, it's a signal, it's a sign of calm. The market is calm, and it's a sign that there are not many changes on positioning in the market. So low realized variance it ties really well with a long gamma regime. This is expected of a long gamma regime, and also ties really well with a market that is drifting upside. And that's what I keep telling all of my members, that all of us are very tempted to start playing downside, because I know the EWT experts are looking for downside, and I eventually will play downside, but not right now until I see consistently realized variance go to tremendously high values. Today, for instance, the open was crazy. Notice that it bravely touched 43, almost 45 at the open. I don't know what happened in the first 10 minutes. Maybe liquidity was completely absent from the market at the open. But then it quickly corrected and started heading down as the session progressed. But if we start to see the opposite of this, if we start to see low realized variance, and then it starts going higher and higher and higher and higher, that's a sign that we are in for downside action. So keep an eye on realized variance. Usually I use a magic number of 12%. It's not a magic number, it's based on historical performance. 12% seems to be the limit when things start to fall apart in the market. So keep an eye on this, and also on the GT level. So if we see realized variance going higher and the market dropping towards 2,794 and about to flip negative, that means that that's it. The floor is about to break and we are going to fall. But right now we are in a good position. So hopefully this short video is more helpful for what the Variance Center can offer to the subscribers of the Gamma Optimizer room. And as usual, if you have questions, just ask me in the room, or through private messages. I'll be more than happy to answer them. Thank you.